Hello everyone, and thank you very much for joining me today in my new YouTube video. I appreciate it's been a while since I last posted. The overall world situation and broad perspective has quickly and radically changed and shifted since my last video. So I decided to sort of take a step back, reassess, and then share again my thoughts, especially after the numbers that came out yesterday. For those of you who don't know what I'm referring to, is the employment, unemployment, and non-farm payroll numbers, mainly in the United States of America. They came out yesterday, Friday the 5th of June, today Saturday. So as you know, every first Friday of each month, the United States of America release and announce the non-farm payroll numbers. What that means is the new numbers in terms of how many people have been employed, which could be positive or negative, in the non-farming sector in the US. As opposed to what everyone was expecting, we're about to sort of take a quick analysis at those numbers. The situation was radically different to what everyone had anticipated and from the general consensus. There was a lot of misunderstanding, we could call it like that, because there's never been that much of a gap between what the economists and the analysts had predicted and to what the actual numbers were. Before we jump onto the charts and combine the fundamental to the technical and put them together to try and gauge an understanding as to where we're next headed, I just wanted to quickly show you an article from Bloomberg. I really do appreciate this website and the content that Bloomberg provides, as opposed to other ones such as CNBC, CNN, and stuff. It seems to be a lot more transparent, professional, and I do appreciate the way that they share their information a lot more. So, just going straight to the point, the economists have been biggest miss ever in US jobs report, so shocker, meaning there's never been, like I previously said, that much of a difference between what the people who are supposed to be professional at predicting what the economy looks like and the situation we're in versus what the real numbers were. So a record 2.5 million workers were added by employees during the month, compared with the median projection for a loss of 7.5 million jobs. What does this mean? Let's go back to the Forex economic calendar, and this is where we want to be focused on. Non-farm payrolls, the concepts I've just explained. We were expecting a minus 8,000 times 1,000, so 1,000K, meaning 8 million people would have lost their job, according to the general consensus. But this is the actual real facts number, was that 2.5 million people were added. So there's a gap of more than 10 million people if you think about what they were expecting and the real numbers. So what is it that is going on here? And if you look at the numbers, you may be left to wonder, who should we believe? Who should we trust? Are these numbers anywhere remotely to getting close to what the actual situation is? Can anyone give us a clearer picture? And if you were to just be looking at the stock market, you'd be thinking that the worst was over. This is the NASDAQ 100, so is a basket of the biggest 100 companies outside of the financial sector. So you've got your Apple, Amazon, Google, Facebook, all these big giants that do not belong to the financial sector, such as banks and JP Morgan, investment asset management. So if you were looking at this chart on the daily, you would realize that, okay, this is where the economy was, or the stock market was, prior to the crash. Okay, but look at where we're at now. So if you were looking at the replay button, you'd be thinking, okay, there's no way we're going to go back to the same levels in so little time. It's only been a couple of months since all of this has started. But look at what the price action shows. And the NASDAQ yesterday, so close of market Friday, the 5th of June, signed the all-time high when the economy is probably at the all-time low. This doesn't seem to be too much of a great image, in the sense that there's never been that much disparity and lack of correlation between the economy and the stock market as a whole. They tried to depict two different pictures, and that's because perhaps the stock market is a vehicle that tries to predict what the future will look like depending on what the current situation is. So it's a discounting mechanism, is a vehicle that tries to predict the near future. Whereas the economy is almost the opposite. You close the quarter, you close the year, you close the 6 months period of trading or whatever, and then you look back at the numbers and you think, where are we? Are we in a similar situation to the previous year? You compare the current data to the historical data to gauge an understanding as to where we're headed based on where we come from. This doesn't seem to be the case at the moment. The economy and the stock market seem to be on two completely different paths and reflecting different worlds. And if you were an economist, you could be completely wrong about something and still sort of hope for the best, because of the fact that, at the end of the day, these numbers are just estimates. But when you look at the fact that the economy is based on people, on individuals, on institutions that are made of humans and people who need to go to work in order to sort of meet month's ends and put food on the table and sort of continue that cycle of life outside of work as well, to keep their family in a good shape and in health as well, then you start to realize that those numbers aren't just a figure on the screen. They reflect what the world's economy is looking like. So nevertheless, these numbers were optimal. They were outside of any sort of boundaries. They were amazing. But my point is, are we getting a bit too ahead of ourselves? Should we continue to be happy and sort of think that the worst is over, or brace for a bit of a pushback? In my opinion, this is likely to happen. A lot of people were thinking about a V-shaped recovery. When I say V-shaped recovery, I mean something that looks like this. So the stock market goes down like it's done, and then it goes back up like a V. Okay, this looks like a letter V. A lot of people then started to sort of exclude that option because it might have been a bit too ambitious. And as opposed to thinking about the V-shaped recovery, they thought about the square root. And like you may remember in school, the square root is something like this. So square root of 10, of 121, of 1,000, whatever. So you've got price going down, then stalling, then going all the way back up, and then sort of phasing a lateral horizontal move where it sort of doesn't move that much, sort of waiting for the next numbers to come out and for reality to catch up. Remember, stock market is a discounting factor. It's trying to predict what the tomorrow will look like based on the yesterday and the today. So we look at the daily and we see that since the economy sort of broke down, it's recovered equally as quickly, if not more quickly, to then reach all-time highs. This is a bit too ambitious because of the fact there's still a lot of people out of jobs, a lot of people on benefits. Here in the UK, where I'm based at the moment, the majority of workers, maybe not the majority, but a good percentage of workers have been furloughed, meaning they have to sort of receive paychecks from the government rather than their actual employers. And this leads to a huge problem. So the government having to borrow money and issuing quantitative easing, in turn devaluing the currency. So you've got all of this issues that is sort of catching like a rat race, and it's not sustainable. That's my main point I want to convey and put across. This sort of movement may not be sustainable in the long term because of the fact that the numbers that we had seen here, so in late February, beginning of March, are they the same? So is the overall health of the economy of people of the world in the same shape as it was 2-3 months ago? My answer would be no. So why would the stock market reflect an equally as good of a picture? That's where my frustration comes in. And I don't believe that this is sort of destined to last for a lot longer. In fact, if we look at the 4-hour chart on the NASDAQ 100, you can see that it's been going on a bull run for a while now, since the sort of end of April. So a few weeks now, where people started gaining back that confidence that countries would be easing out of lockdown, that new subsidies would come out, without actually thinking of the consequences of such actions. So anyway, we've got up until this point, reached the key psychological level 9,750/9,700, where the NASDAQ topped at before it sort of crashed, before the crisis started. And then we can see here my personal prediction. This is just a picture, it's not actual price. I can move this anywhere, of what may actually happen. So we've got this ascending channel, and I've drawn these levels here, psychological, 8,950, 9,100, 9,300, 400, 600, so forth. So every time we've made new highs, high highs, and high lows, meaning we're in an uptrend. This uptrend then formed an ascending channel, which on Friday happened to have closed at exactly the point where it closed 2 months ago. Now, the role of a technical analysis, from a technical analysis standpoint, an ascending channel is a reversal figure, is a reversal pattern. So you've got price going up and up and up, reaching the top, and then following, sort of reversing all the way down. There's something called the 90% rule, which I've studied a few months ago in one of the courses I've taken, that basically says that whenever you've got this ascending channel type formation, and then it tops, and it does, the first sort of area or region, and then you've got the second one, and then the third, and then the fourth. So the pattern is completed because you need at least 3 clear touches, which can be identified. And then at the bottom, we've got 1, 2, 3. So we can say that for sure this is a confirmed pattern. Then there is a 90% chance that we are going to fill 90% of this move. When I mean 90% of this move, I mean from 0 to almost 100%, so almost all of it. If you wanted to help ourselves with the Fibonacci retracement, we'd go here, so from the swing point low to the swing point high, and we'd say, well, the 50% retracement is here, the golden ratio is the 61.8 is down there, which happens to coincide with one of the places where price stalled before breaking up and then retesting and continuing further up. So the clues are there. There is a lot of uncertainty. Not many people know exactly what's going to happen. In fact, no one does. But the situation seems to be quite alarming in the sense that we cannot sustain this kind of growth, at least in the markets, for too long before reality catches up. You could say, well, let's look at other indices. You can't really have a general outlook just by looking at the NASDAQ 100. Absolutely fine. Let's look at the S&P 500, which is sort of like a similar but more of a broader index of the top 500 listed companies in the United States. Look, we're reaching all-time highs. We're about to meet this level here, where price sort of stalled and then retested it before breaking impulsively at 3,224. So I'll be monitoring this area to then, take a look at how price is going to react. And then, okay, so 2 out of 2. Then the USD 30, the Dow Jones, as many people know it. Similar thing. So it's stalled up to here in the 27,500. And now we're about to approach it. When we approach it with this sort of price action, then it's likely to sort of follow a very similar sort of V-shaped recovery, which would then be like a big A or an inverse V. But then you may think, well, okay, that's just the Americas. Let's look at other parts of the world. Okay, what's there left? Europe, Asia. Okay, let's look at Europe. Italy is also going very on a high rant, so going all the way up to previous levels. But the most important one when you look at the European Union is the DAX, the Germany 30. Obviously, as you know, Germany is the biggest economy in the European Union, so it is only fair to analyze that as the main sort of benchmark or index. The 4 hour shows a clear picture. We've broken levels such as this one, and then retested it, this one, and then retested it to continue higher. That's probably bit too much of an ambitious goal to reach the 13,800 levels, but you never know. I could be completely wrong. These predictions could be could turn out to be false, but I'm just thinking and putting all the pieces of a puzzle together to try and gauge an understanding of what we may expect in. So across the globe, then the picture is kind of similar in the sense that we've got contrasting factors from the economy and the stock market. The economy is saying one thing, the stock market is depicting another one. Investors may be getting a bit too caught up with the euphoria of taking profits. Also, we know that the period of July and August is the slowest few months of the stock market because people are usually going on holiday, or if not, maybe this year they will be taking a rest and enjoying their profits for the year, if there's been any. And so we may see a lower volatility. The VIX index, let's have a look at that as well, which is the index that measures the volatility. of the S&P 500 mainly could also sort of, it's already calming down. So we may think that, okay, not much liquidity and volatility will be there anymore. So there could be a slight correction. So everything is sort of pointing in the right direction. Like I've said, I could be wrong. And I want to see how the next few weeks and months play out to study the evolvement of the economy and to sort of be better prepared in the future. But that was it. Just a few points there and some food for thought. Please let me know your comments of any challenging points, and we'll discuss. Thank you very much.